that was one thing that was, I wouldn't say concerning me, but I am cautious. I'm sharing only a little bit of what I know. I know there are options, especially, is a very, very wide world, right? I mean, at the core, it's pretty simple. And there are, two types of options, and you can either buy or sell them. It's the strategies that you can use using those two instruments and how you club them together and come up with, very complex and advanced strategies. As Krishna was saying, he's doing level 1 and level 2. If I go to E-Trade has classified options into 4 levels. And yeah, level 1 and level 2 is where I am in. I'm very comfortable with them. Level 3 and level 4 are pretty complex. And I'll just give you a glimpse of that a little bit, maybe.
Sure. Maybe you can explain
to,
what level 1 and level 2 is as well.
Yeah, we will get to that. I mean, as I go through the slides, I will cover all of that.
Awesome.
I was just waiting for, can we get started? I mean,
yeah, we can get started. I just started recording, and hey, good afternoon, everyone. We have about 35 people, so looking forward to an exciting session. Go ahead, Chak.
Okay. All right. So today we are going to cover options. Specifically, I'm going to share how I'm using covered calls, how I'm selling covered calls, and cover that. But before I do that, I need to explain probably what options are for some of the new people. And so there are many slides in the beginning that actually is more like an introductions to options. And the reason I'm doing that is okay. All right. So the reason I put, when I was trying to put this together, I realized that there are many ways to trade options. And when I looked at options many years ago, I struggled a little bit. I know some of my friends who are doing locally, they were very heavily into options. I tried to follow them. I really didn't get quite the hang of it, right? I tried to do my own research and it looked pretty reasonable. But then when I log into my brokerage, I was really lost. I wasn't sure. The screens I'm looking at didn't make any sense to me. So I gave up. And then only about 2 years ago, I picked it up again and started to do that. So I thought, if there are other people like me who are curious about options and trying to understand what they are and how to get started. So I thought maybe I'll start with that, like an introductions to options. That will be the goal today. What are options? How many different types are there? What are the different strategies you can use? And towards the end, specifically, I will cover how I'm using covered calls, for example, to generate income. That is my strategy. And then towards the very end, I actually have screenshots from a brokerage, the E-Trade I'm using on, how does it look like? How do you step through these screens to actually place an options trade? How does it look like? How do you interact with it? What do you do in different scenarios? So hopefully that should, once you go through the material, you should have a good understanding of how to go about and do this on your own if you have never done it. So that would be the goal today.
Cool. Sounds good.
Yeah. So, feel free to chime in. Like I said, we have many people on the group. Some of them are probably more experienced than me when it comes to options. So let this be interactive. Don't wait for me to, explain everything. Jump in, chime in. If I misstate something, if you have an updated information, something that is more relevant, feel free to jump in and provide that insight. Okay, that's my coffee. Okay, so let's get started. So what is a stock option, right? An option is a contract to buy or sell a specific stock. I say stock, but any equity, any instrument. For many of us, if you're working at an employer, the employer might give you stock options, which are nothing but just one form of option. So each option contract has about 100 shares. So that's so it's always like that. One option contract is equivalent to 100 shares. And there are certain elements to an option, just like a stock has a value, a price. Auction has that too. So option has a strike price, and it's the price at which the contract can be executed upon. And when you go and try to trade options, there are many strike prices that you can choose based on your comfort level. Options will have an expiration date, and that's the date at which that particular option expires. And after that particular date, the option does not have any value. It's zero. They expire typically on a Friday, unless you have a holiday or something going on. Some might expire on Thursday, but typically they expire on Friday, and after 4 p.m., they're you cannot trade them actively, I think. And then if that Friday is an expiration date, after that, the option value would be 0. There is nothing that you do with that option. And then every option for an expiration date and a strike price, there is a premium. The premium is the price that you trade with. It's the amount either you pay or you collect. It just like for a stock, when you're buying or you're selling. So that's the premium is the amount that we look at when you're trying to see how much we can get or how much we have to pay to buy that option. And similar to a stock, it's typically there is a bid-ask spread. So you might have to select a price point at which you can buy or sell an option. So those are the elements of the options. Now, there are 2 types of options. There are calls and there are puts. That's it. And then you also have, you are either a buyer or a seller. So I'm trying to put together this slide that tells you the differences between, buys and calls, and what do you do, what's the buyer responsibility, what is the seller responsibility, and I will try to walk through that. So for options, for the call options, if you are a buyer, you pay the money to buy that option. What that gives you is, it gives you the right to buy that equity at the price that option is for. And the reason I would buy a call is I want the option, I want the strike price to go up. So that's when I make the money. So whereas a put option is buyer, again, same thing, as a buyer, I pay a premium to buy a put, and it gives me the right to sell a stock at a certain price. And as we step through certain screens, I can show you how it looks like actually. But that's what does, as a buyer, you always have the right to do what you want to do, that particular option. Seller, whether you're selling a call or a put, collects a premium. So you collect money upfront, and no matter what, that money is yours. That's always yours. Nothing, whatever happens in the market, you have the premium for sure. What you also have as an obligation is to sell the shares at that particular price when the expiration comes, and you have no choice. You cannot say that I don't want to sell my shares at this price, for example. So once you are a seller, you have an obligation to sell if the strike price of a particular stock reaches that value.
So, Chakri, can I jump in with a couple of things here?
Yeah, sure.
Yeah, so the 100 shares per contract that's the standard, but recently they also introduced mini options. So that you can, on some exchanges, some stock, you can buy 10 share contract. They're called minis.
Yeah, I've heard about that. Good point. The big brokerages provide that, or is there a special,
yeah, big
brokerages?
No, I haven't traded them, but in a typical options trading account, yeah, you should be able to do that if you
cool.
Look into it. I haven't done it, so I cannot tell you exactly what to do, but it's not that hard. I mean, if you're an options trader, you can go. So what that gives you is you can trade with something like Amazon, for example.
Yeah,
you might wanna deal with just a mini or on exchange traded funds like QQQ or SPY or whatever. So that's fun. So the second thing is
I can see that.
So the second thing, very important to remember, is all the options we're talking about are called US style options. So because you're talking about 4 p.m. Friday, right? So in a US style option, let's say you sold a call. I'm the holder of a call. I can come exercise my option anytime before 4 p.m. from the time I bought the option to 4 p.m. when it expires. It could be 1 year, right? So that's typically, so don't assume that you would only have to settle at 4 p.m. So somebody can come and take that stock away from you well before the expiry. So that's the US style options. There is another option style called the European style option. Obviously, you don't see them here in the US as much. That is only settles at the close at 4 p.m. or whatever. You cannot trade that before. So you're making a bet that at that particular time, that price will be so and so, and you settle only once. But again, the reason I'm talking about this is you might see European style options versus US style options, and that's the difference. But for most purposes, you're dealing with 100 share contract, and you're dealing with US style where people can exercise anytime they want before the expiration.
Okay, that's good info, Krishna. What we'll do is, once we get to I have a screenshot of what an option screen looks like. We might dwell on that a little bit on, what those differences are. But you're right. I mean, the options I'm talking about are US options only. I wish they were European style options, right? But they don't get exercised before that expiration. But yeah, most of
I think for our
US
discussion,
style.
we can just focus on the US style.
Yeah, definitely. I mean, that's the intent. Yeah, that's the only minor difference, right? European ones there is only on the last day there is some action, whereas US ones can anytime you can exercise that. So let's actually take once we get to the screen, we'll touch on it. So the question would be, many of you, if you have not at all looked at options, might be wondering, why do we have to look at options, right? I'm buying stock. I mean, why should I even look at options? It's a good bull market, for the last 15 years, maybe. So why should I even look into options? So fair question. So I thought, let me put that, the thing that helped me together and then do a comparison, right? So for example, this is what I'm trying to show. Like when you buy a stock, for example, let's take Apple. Let's say it's at 390. And you want to buy 100 shares of Apple, your cost would be $39,000, right? What's the upside? What's the reward? There is no limit. You can make as much money as Apple appreciates. Your risk is, of course, $39,000, the amount that you put up. So let's say in a month, Apple does spike, it goes to 450. Your profit is $6,000 on that, right? So you spend 39, but you can sell it for 45,000 and you can recoup 6,000 as your profit. So that is your return on your investment, 6,000 on a capital investment of 39,000, which is a substantial investment for many. Now, this is what a typical option screen look like. And the reason I bring it up is, and we'll probably come back to it a couple of times, I want to show you that when I'm comparing with an option return on investment, I want to show August 14th date. For August 14th, just keep this number in mind. 395 is the strike price. And let's say 16 is the premium, right? So let's keep that in mind. And that's what I'll do. For options, the reason we do options is the return on investment. And as I step through this, you'll get an idea. So I'm going to, instead of buying 100 shares of Apple, I am going to buy one contract for August 14th for Apple for 395, right? So Apple is at 390 right now, and I am buying a call for 390. I'm assuming that Apple will spike. It's been a great market. I'm very bullish on Apple. So I'm going to pay 16 premium to buy that call. Now 16 is the premium, and as I said, each option contract is 100 shares. So essentially you'll have to pay $1,600, 16 times 100. 1,600 is your price to buy that option. So just look at the comparison. To buy 100 shares of Apple, you have to put $39,000. To buy a contract of Apple, you are putting $1,600. The risk, this is your risk. $1,600 is your risk. Again, reward is, there is no limit for buying a call option. So for example, if Apple does go to 450, you can potentially, and this is where, Krishna's point is important for US options. Let's say tomorrow, Monday, Apple spikes to 450. I don't have to wait till August 14th. I can, as a buyer, I have the right to buy Apple at 395. and I will exercise my option, I'm going to say, hey, whoever sold me this option, give me the shares for $395 and buy those shares for $395, sell them right away on the market for $450 and make $5,500 profit. And I can do this anytime it hits anytime it hits above my price point, before August 14th. So my profit would be $5,500, but then of course I did pay $1,600 premium, right? So my profit is $3,900. But look at the return on investment. I made $3,900 return on investment on $1,600, the investment that I had made. So that is the true power of options, on why some people are really drawn to it. So that's the one big advantage of options, of the leverage that you can have with one contract. Any questions, comments, or on this one? Does it make sense on the comparison of these two?
Yes, Chak, thank you. We got it positive. What is the negative side on this? Like if it goes less, like you expect it to go into 450, but what is the negative side on this? What will be the loss at that moment?
Yeah. Let's look at that. Yeah, right. I mean, for many people, and I will say that upfront, when I looked at it initially, I said, you know what, why? I mean, what if Apple doesn't go to 450, right? What if it doesn't falls below 450? I'm going to 1,600 for nothing, right? That is true. But let's take a look at that, realistic scenario. So again, let's say 100 shares of Apple, I bought it at 390. There is a crash. Apple is now at 300. My loss would be, 90 per share. So which is about $9,000. That's on the right-hand side. If I had actual ownership of those. Let's look at options, right? So I paid $1,600 to buy the 395 call for August 14th. But on August 14th, whenever it crashed, on August 14th, it's still at 300. What happens? The option at 4 p.m., the option expires. What do I get? I get nothing. What do I lose? The premium I paid a month ago for $1,600, that's my loss. So in the event of a crash, for example, or not even a crash, a correction, or just the stock slides down, as a buyer, your loss is $1,600 compared to if you are an owner of the shares. So people who really don't want to own options, this is a great strategy. And that's one of the reasons people like to play with options, because you don't have to own shares and you can still participate in the profit, limit your losses, and get some reward.
Okay.
So does this answer the loss question? Yeah, the loss is always, you will not lose more than the premium that you paid, whatever the premium is, whether it's $30, whether it's, in the case of Amazon options, you have to pay $15,000 sometimes. So that'll be your loss. But compared to buying 100 shares of Amazon, it's probably much less in terms of impact, right? So that's what the power of options is.
Chuck, but at the same token, I can have a stop loss limit of like say 3 or 4% below my buy price.
True.
And protect my downside, right? If it was a regular stock trade.
Yeah, absolutely. And the funny thing is, actually, with options also you can protect your shares. You can buy, and that's where puts come in. Remember, the puts was
okay.
You go back, you can. Where was that?
So basically, you're hedging at that point.
Yeah. So I'm talking about calls, but there are puts also where you pay a premium. So you actually can select that price point. You can, instead of doing stop loss, you can say, you know what, I want to buy a put for 380. 1 year from now. And you might pay some money for it. So after 1 year, regardless of what happens, if the stock does fall or crash, you would still pay 380. So I'll get to one of those things. So everything, the benefits of options are, if you want to go into options, is the flexibility it provides, right? So I just touched on one scenario of buying one call. What happens when the stock appreciates?
And Chak, quick question, like when there is a swing in the market, like it went to 300 today, comes back to 380 next day, so you can wait till the option expires, right? You don't need to execute when the rate falls, right? You still have the time till
Yeah, good point. Yeah, I mean, you can. And, when I talk about my strategy, I will probably provide a glimpse of how I handle that. I typically do not worry about what's happening, right? Because my strategy is selling calls. So I don't want the price to reach the strike price. But as with stock, with options also, you can sell them anytime. And if you think that its stock is falling and your buy call is losing money, you can close it out. So you don't have to wait till August 14th. If you think the stock is moving in a different direction than you anticipated, you can do that. So it all depends on what strategy you select. If you're bullish and you're buying calls, but the market reverses, you can quickly close out those calls. Same as like Suman is saying that have a stop loss. You can have that for options also. Once it starts falling and close it out losses, you don't have to lose all of 1600, for example, if that makes sense.
So can I just add one thing here, Chak, about selling options that you hold? So there are two things to think about. One is there is no aftermarket or pre-market trading in options. So if, and a lot of times I do a lot of stock trading before and after. If I'm holding an option, I'm like, damn, I can't do anything about it. That's one. And two, usually at the market open, depending on something like Microsoft or whatever, they trade very actively, but there are a lot of stocks whose options don't trade that actively. So typically at market open for the first 1 or 2 hours, there's a very wide spread. So you cannot really, on a $3 option, the spread might be $1. So you really have to take a huge loss to get out if you just want to get out. So they're not as liquid as stock. So just to remember.
Yeah, again, you touched on
that's a good point.
Good point. Yeah, you touched on a point. So towards the end, I put on a slide where, what are some of the tips, right? And so some of my recommendations were, look for those heavy volume ones, do not buy options on trades that are not, actively traded in options, right? So, and you would, as you play with options, you will get a sense of that based on the bid and ask spreads. You would get an idea of how active they are. So let's, we talked about a scenario when the stock appreciates, and we talked about a scenario when it falls down. But I didn't talk about the break even, right? So we talked, if the stock appreciates to 450, you make money, but at what point do you actually profit? Is it right after the stock crosses 395? That is not the case. For example, you paid 1600 for this call, right? Same call, same day. Let's say Apple goes just $10 above that. It's at 405. So you're getting about $1,000. Good, but then it is actually a loss because you paid 1600, right? So getting the stock to 405 on August 14 doesn't help you much. It'll actually give you a lot. So there is a break-even point for this strategy, which is, for example, in this particular scenario, the break-even is 395 plus 16, right, which is 411. So if only Apple crosses 411 is when your buy call is actually, it's profitable for you. That is your break-even point, just so you know. And this is an interesting slide, right? So I am talking. I think Krishna mentioned, he's level 1 and level 2. So this is the E-Trade's levels. They have 4 levels. Level 1 is covered calls, which I'm going to talk about in a little bit. Level 2 is, look at this. They have calls, puts, married puts, productive puts, cash puts, collars, straddles, triangles. Level 3 has even fancier names: butterfly, condor, iron condor. And level 4 is straddles and strangles. So as you see, we only talked about buys and puts. Calls and puts, right? And what are all of these? These are just a combination of, instead of just buying one call or one put, or selling one call and one put, all of these fancy names are a collection of that strategy. So for example, iron condor will be you buy 2 puts, and then you basically make 4 option contract buys or sells at one time together with the name iron condor. Those kinds of things. So based on how you use it, whether you're selling or buying, the combination of you don't have to just buy one contract. You can combine, you can sell at the same time. You can do different things. So by combining those 4 elements of buying, selling, call and a put, you can go with different strategies. And these are well-established strategies. This is the E-Trade view. If you go to TD Ameritrade, you'll probably see fewer options, but they probably combine debit and credit into one. Just call it iron condor and give you an option to buy or sell, for example. For this particular session, we are going to skip all of this. I mean, this is way too much. And to be honest, I'm not even comfortable covering any of these. I have not started playing with them yet. I have an understanding, but it's not, it doesn't just rhyme, with my philosophy or strategy at this moment in time. My goal, and as with all of these strategies, is what is your goal? Based on your goal, and I try to put together a decision matrix here, right? Are you typically bullish? Are you bearish? Or, do you think do you have you don't care, it's a neutral outlook? Or do you want to buy and speculate? Or do you want to sell and, get some income? Do you want to play with options so that you have high reward? Or do you want to play with options where you have high probability but low reward? So they go hand in hand. So based on that decision matrix, you can say, if I'm a bullish and I want to buy, I want to high reward, I want to buy a call, for example, something like that. So I was thinking of putting together a matrix for each of these to explain, what you should do, but maybe it's too much, for this session. Maybe in the future, if I'm knowledgeable enough, I'll do that. But for today, I'm going to cover a strategy where I am bullish, and I hope that market is bullish, and I'm going to sell calls, and I want to collect those premiums, right? So in the previous slide, we talked about 1,600 premium. The buyer is paying 1,600 premium, and I'm thinking, what? I want to be the seller to this buyer. I want to get that 1,600 so that I keep it no matter what. Right? So that is my strategy, basically. That I want to be the seller, and that is typically called selling a call. And we give it a fancy name, covered call, and that's what I'll cover as we go forward. What is a covered call? So covered call is you're essentially selling a call and you own 100 shares of that stock. And that's when it is called covered. If you don't own 100 shares, it's called, I think, writing naked calls. And it is as risky as shorting, and maybe times 100 because each contract is 100 shares, right? So, the E-Trade, I think you cannot even write naked calls as we showed in the previous slide. You need to have, to be able to sell calls without owning, you need to have margin approval. So that's level 3 and level 4, I think. So E-Trade typically will say, you'll have to apply for margins, and then you should be able to, handle that risk. Essentially, I never sell naked calls. I would never recommend anyone on this group or anyone outside of this group to sell, calls without owning the stock. Because as you can imagine, right, if you sell a call, you collect 1,600. Well, what if Apple goes to, $2,000? You will have to buy 100 shares of Apple at $2,000 so that you can sell it at $395, because that's what your obligation was as a seller. So never do that. Is that point clear, or should we go back to the slide and touch on this, right? So do this. As a buyer, you're paying 1,600. As a seller, you collect the 1,600, but you have an obligation to sell at 395, no matter what, right? I mean, especially if it's above 395. So if Apple does go to, let's say, 1,000, you will have to buy 100 shares of Apple at $1,000 a piece, so that you can hand it over to the buyer at 395. You will have a huge loss if you do that. So as a principle, I never write calls without owning the stock, and I would recommend the same to everyone. Now, as someone asks, what's the catch? What's flip side of it looks good, right? You price at which I'm willing to give up getting a premium. I am giving up the possibility of any profits I would get, beyond that level. And
yeah, Chak, I think you're cutting out. Your audio is cutting out a little bit. Others having the same problem?
Yeah, I had the same problem.
Okay.
Yeah, we have the same problem.
Maybe it's a headset or something. I don't know. Check. Just check.
We lose him completely. I think we lost him.
Check. You still there? Yeah, I think we lost him.
Hey, this is MSN. Quick question. So who is doing this? Because this is apparently risky. So who is in the business of doing this? And are there any kind of limitations, as in you only have a bucket of this available? And if August 5th, this option is gone at that price, it's completely gone, or are they unlimited supply?
Hey, this is Raj. Can I jump in and give you what I understand about this?
Suman? Yeah, Raj,
Sure.
You do a lot of options. Please chime in.
Yeah, I mean, I basically, it is designed for us to understand that, okay, somebody is willing to put up their stocks, right, against which they are selling covered calls, etc. And somebody at the other side is ready to buy that. A broker firm in the middle, actually handles it. And that's why there will be literally unlimited supply. As long as there is demand for people ready to buy option, and there is a supply of people ready to put up their stocks to sell options against, the broker in the middle will do all of that trading. So you really never see the other person, or you never really are transacting with the individual. You are basically trading it through E-Trade like a normal trade, or through TD like a normal trade. And the brokerage house, they are called the market makers term. They are the one who basically take the commitment and they live up to their commitment. Does that answer your question? Yes.
MSN, you there?
Yeah, I'm still here.
Raj,
Yeah,
if I
I'm
may
here.
follow up on that. And so clearly, as Chakri was sharing earlier, you need fairly low capital to play the options market, right? Or at least
Right.
lower than the equity. And so the biggest risk being the time factor, or whatever the time length that you buy or sell. If we were to stretch that out, the time period to longer and longer period, then you would have enough time to play for all of these swings and still play with a significantly lower capital than playing the equity market, right?
Yeah, that is true. However, the longer time frame you're buying the option for, the higher the premium you're paying for it. Because the price of an option is based on, and how the market makers make it, it is based on the strike price for which you are buying the option and how much time you are buying for yourself. Now, it used to be at one point, there were only monthly options on the third Friday of every month. But after a while, with all the technologies and lots of interest in options, now we have weekly option. That means every Friday, there are options available that expires at 4 o'clock every Friday. So if you buy a weekly option, you find the difference, unless of course the stock itself is a volatile stock, where it goes up $10, $20, then the premium is according to that. But if it's say you take a simple stock like let's say Walmart, right? You'll find that okay, Walmart doesn't move a lot up or down, and you buy a weekly. So let's say it's at 130, and you buy a 135 option or 132.5 option. You'll only pay pennies for those options because you are buying very little time. So I'm going back to your point that if you do a long-term, then you are paying a much higher premium, the strike price.
By the way, Walmart moves only when Suman buys.
Come on.
Yeah, remember like 2 weeks ago, that was exception to the rule. Right?
That is true. That is true. Thanks to the new announcement of their prime competitor.
Exactly. Yeah, that's the first and only time I'll probably buy Walmart.
Yeah.
Yeah.
You know, and while we're waiting for Chakri, just kind of sharing with you that we do a lot of option trading and covered calls in our IRA. And a lot of people think that IRAs, you know, self-directed IRAs are only for stocks. Not true. You can actually use it to do covered calls. You can also, as long as you have enough call, you can even sell puts in there. And benefit of that is that, let's say if you end up having a bumper, you hit the jackpot and you get the stock that really is taking off, and now you're suddenly sitting on this huge capital gain. Well, since it's in IRA, you know, you can flip it much faster and not worry about the capital gains part. So that's a great place to what's called play options in the IRA. Now in the IRA, I don't think you can do just open calls. You can do covered calls and you can do covered puts, just FYI.
Yeah, the one way as a stock trader, the one thing I understood about options was the premium you pay is pretty much like the premium you pay for insurance. You're paying the insurance for a period of time, and the longer the period, you pay more. That's it.
That's correct. That's correct. Yeah.
And if you don't use it, you lose it.
Yep. That's right. That's right. One other thing from experience I'll share with you that, you know, let's say about a weekly option. So next Friday's option, Monday morning, you an option for a stock XYZ, and you have a strike price of, let's say, going over $5 of that stock, right? Now, throughout the week, as long as you're monitoring it, that option premium is fluctuating quite a bit. And I personally believe a person who is attentive, you know, as long as you're, you know, going after the right kind of stocks, you will see 10, 20 swing in option prices. So, I mean, I'm talking about percentage here. So, you know, if you lock in your profit early, you know, since it's not a European stock, you can do it at any given time. Anytime you feel uncomfortable, anytime there is some news coming out that you feel maybe negative to the stock, underlying stock, you know, you can, and you can just go ahead and close your position, book your profit. So I think that's one thing that an attentive option trader can make significant percentage, which you really cannot get in a stock movement.
Raj and Suman and Govind, I've seen messages on our group. Sometimes we use the options data, such as the ratio, the cost volume, the put value, volume,
Yes.
to decide how to trade on the stock itself, whether you should go longer on it or short on it. How do you guys use that?
It's very simple. If it is a call option, you want to go long, and you look at the strike price in the month. So, for example, I think we were talking about mRNA. Moderna had 105 call options, call sweeps, when the stock was around like 91 or so. So that means that, you know, professional options traders are expecting it to go to 105 by August. And since the price at 91, I would go long and, you know, play the stock movement. And sure enough, you know, it moved from 91 to 95 within like an hour or something.
So looking at the volume, the call.
Hey guys, quick to interrupt. Hey guys,
Chak,
this is Chak. I just realized that actually I got kicked out. I don't even know when that happened.
No, yeah,
I was
you dropped. Yeah, I think you're.
We are just holding the fort for you, Chakri.
Connection is not great.
So you've been
having some
presenting
audio
all
issues
along?
before that too. And
yeah,
then,
I was, and I was surprised because, you know, there was some good interaction, you know, people chiming in, and there were a couple of slides. I was like, hey guys, what do you think? There was nothing. I was like, okay, that's fine. Maybe I explained it so well. You know, sometimes you do such a great job that there are no questions, right? So I kept on moving along, and then I got suspicious. So I can pick it
Yeah,
back up if you can
Raj
continue
Asava
where you
actually
lost.
chimed in and we had a good conversation
Hilarious.
about yeah. So, Chuck, why don't you start sharing your screen and continue?
Okay, you will have to help me with, where I stopped. Let me share my screen again.
Yeah.
Yeah, you guys can continue the discussion. Something is happening with my internet connection. Hold on.
Yep, it always happens in the worst times.
When the kids are launching
Murphy's Law.
Fortnite, that's when it takes the most bandwidth. Once it launches and they start taking.
Yeah, if you have a bad internet connection, one thing I can do is, since you sent me the deck, I can share my screen. Should I do that?
I think Chakri is on, right? Yeah.
No, I'm here. I think, yeah, my internet has been giving me problems the last couple of days. Actually, it happened to me yesterday at work. I got kicked out, and it was a problem. But let's continue. Let's, I'll share my screen. It's easier. Just tell me, which screen I was on. What point did I cut off? Did I talk about this screen, the decision matrix?
Yeah.
I think we were in the previous one with all the fancy titles. Yeah.
Oh, okay, the fancy. Yeah. So I think when I got back in, you were having the discussion, right? On when should I buy, should I sell? It really, for options, you will have to see, which one is the best one for your strategy. Maybe in the future, we can put together some slides on, what do you want to do? What does each of these strategies mean, and how do you handle that? But options does give you the flexibility to play the market regardless of, what's happening. There is a strategy for every wish. Whatever you want to do, there is an option strategy for that. That's what I learned. So let's continue. So I think let me cover the covered calls, right? So this is where I probably cut off, you were saying. So let me try to give a passionate speech about covered call again. So what is a covered call? Covered call is you sell a call when you own 100 shares of that stock. That's when it's called covered. Again, one contract is 100 shares. So if you have 100 shares, you can sell one covered call for that. Now, you can also sell calls without owning the stock, and that is called naked calls. That is level 3 or level 4 in E-Trade. It's as risky as shorting, and that's why they require, they need a margins approval for you to do that, because you're essentially betting that the stock will not appreciate, collecting the premium, and then when the stock does appreciate, you will have to buy the stock back at the price that you set it up, and sell it at a low price and buy it at a high price. So it is very, very risky. I would recommend that you never write covered calls without owning the stock. Again, remember, covered calls is level 1. You own 100 shares. That's why you're selling a call. Simplest strategy ever, and that's why it's level 1. And the brokerage doesn't require you to have any margin or anything for that. Now, there is a catch, as with everything, that it's a simple strategy. You collect premiums, make money, but what you're giving up is the possibility of collecting any profits above that price. So in the previous example, if I have 100 shares of Apple, it's at 390 right now. I sell a call for 395. I collect 1600. Great. But if Apple goes anything beyond 395, I do not participate in that price action, right? So I can only sell. I am obligated to sell at 395, regardless of wherever Apple is. So that's what I'm giving up. You guys still with me? I'm going to ask this question after each slide. No.
Yes.
Good. Okay. So your question will be, why should I sell a covered call, right? I mean, if I have 100 shares, if I own 100 shares, I'm happy with that. I don't have to sell a call.
No, I didn't
which
get
is true.
is like you hit the strike price 395 for Apple. So do you own now the Apple stock for 100 shares contract? So then you go sell the cover call after that?
Yeah, you have 100 shares and then you can sell covered. You can sell that call. And I will actually show you 2 ways you can do that, right? If you don't have 100 shares, you can still sell a covered call. By selecting covered call option strategy, without owning, what will happen is you will automatically be asked to buy 100 shares, right? And I will show that in a screen, once we get to that, so that you get a clear understanding. Yes, yeah, and you're a good question though. Okay? So if I have 100 shares, I can sell a call. If I don't have 100 shares, I can still sell a covered call by selecting covered call option, in which case I will have to buy 100 shares and sell a call at the same time. So I'll have to do both of those. And I will show that in a screen in the future. So stick with me. So again, why a covered call, right? Because you're losing on any upside. Good point. You don't have to do that. But if you do remember that you are setting up a price in future at which you want to sell. Yeah, it's kind of like locking in your profit. Apple is at 390. You can set a price saying, I'll be happy to sell Apple at 425. You get to choose that strike price or what makes you comfortable. And you should be happy to be able to sell at that price and take that money. And don't be sad that it goes beyond 425, you're missing out, right? So if you have that kind of strategy, that's an advantage. So you can choose that strike price. And then, you get to generate income on top of that. It's kind of like a defensive strategy, right?
I'll have one pull with tuna.
Yeah, sure. Sorry, what was the question again? Sorry.
I think someone is ordering lunch.
Tuna sandwich.
Okay, yeah.
Okay.
If you would please go on mute.
Let me take a
Please
pause
go
and
on
get
mute
me
if you're
some
not
coffee.
talking.
Yeah. Okay. All right. So it's like a defensive mechanism, right? Actually, before I sold covered calls, if a stock that I have dipped in price, I would be sad, that, hey, oh my God, my Apple has gone to 380 now, 370 now. Nowadays, I'm actually happy if that happens, right? Because I'm looking at August 14th. If Apple falls today, tomorrow, 370, I'm so happy because I have a feeling that it will never reach 395 on August 14th. And what does that mean? That I can sell another call for September. And again, if it doesn't reach a price that I set in September, I can sell another call in October. And I can do that again and again and again and again till the moment when the actual, eventually the strike price might hit someday that you selected on an expiration date, and your shares will be called away. Now, if that happens, you still have the option, you're still selling at a high price. So you can again buy 100 shares and keep doing this again. There is no limit to this strategy. You can keep doing this forever and keep collecting income. So that's the reason I like it. But like I said, again, you're missing out if there is a huge swing in the market.
Yeah. So basically, this is great for buy and hold stocks. You're basically collecting rent, correct?
Yeah, exactly. So for an income generating strategy, covered call is a good option strategy. If you have, some other strategy that you want to do, then you guys talked about swing trading and all of those terms are used. There are actual option strategies to profit from that, so that you don't have to actually buy 50 or 100 shares of a stock to do this swing trading. You can actually buy one option at a reduced price and still participate in that swing or breakouts or whatever, based on what do you want to do. So very flexible, as I showed in the previous screen. Many strategies to choose from depending on what you want to do. But I'm betting that anything that you want to do, there is an option strategy. You just have to club them together. Right? So let's take a quick look again at covered call in action. I'm going to emphasize this one. There is a lot of static in the background. Can someone go on mute? Oh, was it me? Yeah, I think there is an echo here.
Yeah, might be you. I muted everybody.
I think there is echo from Sunny.
Yeah. Okay. Let me see. You guys can hear me. That's good enough, right? So, so let's take a look at covered call in action.
Yeah, it's better now.
Better. Okay. Let's say you have 100 shares of Apple. Wherever you got it, selling August 14, 395 call. You get $16 is the premium, which means you collect 16 times on that $1,600. That's what you collect. Your risk is zero. No matter what, you will keep that 1,600. The only risk you have is, as I mentioned, if stock goes beyond 395. So let's take a look at that. What is if Apple is at 450 on August 14th, right? Your 100 shares will be called away. They call this exercise or assignment, your brokerage will assign those 100 shares to the buyer of the call at 395. So you will get 39,500 deposited into your account, in your brokerage account, and your shares will disappear. Now, so that is a problem, right? Because Apple is at 450. Without a covered call, you could have obtained 45,000. So it's a paper loss, right? You lost 6,000 just like that. But then if you look at the overall picture, your profit was, the price that you selected, that you want to sell Apple at 395 minus whatever your initial cost was, plus the 1,600 you you collected. So that's the profit. You do lose on some upside, but again, there are some
and even if
strategies
your shares get called away, you can always buy them back, right?
Yeah, absolutely, and I've done that. Yeah, absolutely. Yeah, it's not all is lost, right? So that's what I'm trying to say in this grid. You're right. You can again buy and again sell a covered call if you want. That's the advantage to me. It's the income I keep collecting. Right?
Yeah.
And that's
So
the reason I
maybe
got
a
it.
general
Because
question for those of you who do a lot of options. Apple, I would think, is a great way to do covered calls. It's one of the hot stocks. Are there any other stocks that you guys would recommend for a covered call strategy where the premiums are, pretty decent?
I mean, the best one would be Amazon, right? I mean, Amazon, you can collect, I think, just go to the Amazon's option screen. I think August calls, you can collect $20,000, $15,000, for a little bit of price appreciation in Amazon. So the option price is based on the share price, on the date, on the strike price. So all of those, there is a complex formula that calculates the premium. And you're right, if you, for example, AT&T is a very heavy volume stock too, but its strike price is 30, right? If you sell a premium, if you sell a call on AT&T, you will get only $30, right? But again, let me go back to the screen just to give you guys an idea, right? When you go to the option state, in the middle you'll see the strike price, right? As the strike price goes on up, the premium you select decreases. So you can sell an Apple call for, let's say, 450. You won't collect 1,600 for that, right? You are collecting, it's 1,800 now for 390. Okay, 1,800 for 390. But if you want to sell it for 397, the premium is for, let's say, 1,485, right? The premium keeps on dropping the higher strike price you select for a covered call.
The probability goes lower.
So is there a particular strategy that you use, Chakri, as to how you choose a strike price that gives you the optimum premium, at the same time doesn't get executed, right? How do you go about it?
I mean, we are no experts, man. That's what I tell you, right? I mean, no expert. I thought I had a strategy. This whole COVID thing, I've been using covered calls. I have about 20 covered calls for 20 different stocks. And I mentioned them in our trading group, right? And I was so happy with them since I got into covered calls, because I've been generating money. I think of it as free money that I've been generating for the past 2 years. A little bit, not too much. I don't have Amazon, right? So I don't generate 15,000 per month. But a few $100s per month just for doing nothing is how I used to look at it. And then this COVID thing happened. Pretty much everything has spiked up so much that all my covered calls, regardless of whatever price I'm selecting, the stock is going beyond those prices. So I will talk about that. What do you do in that scenario, right? But my strategy is basically I select a price that I'm confident that the stock will never reach. I mean, I know that I'll make a profit if I select a lower price, but my goal is the stocks I buy, I really don't want to sell them, right? So I want to keep them. The reason I got into covered calls, my strategy was I've been buying stocks, 10 at a time, 20 at a time, like 50 at a time, whatever, based on the stock price. There are many stocks that I have 100 shares, for example, and I've been sitting on them. And I thought, maybe I should make some money out of that, but I really don't want to lose those stocks, right? So that's why my strategy.
But what is the big deal? If you get called, you can buy them again, right?
I know. I know.
Yeah,
I think you're right. It's just emotional.
No, there are two things here, Chakri. This is Raj. Yeah. One is the emotional part, which frankly speaking, you need to get out of it because you're not in the emotion business, the stock market. But the second thing is the capital gains. The fact is that, we have, some of us, we've been fortunate. We have Apple that we bought in double digits, right? Now it's triple digits. So the question is, if it gets called out, then suddenly you're sitting on a bumper profit. That means you have to give Uncle Sam 33% or whatever, 35%, etc. So you have to be very careful about that. And that's why when Chakri was out, I mentioned to you that we use IRA aggressively so that if in fact we have a stock that called out that gives us a bumper profit, we don't at least have to worry about capital gains at this time. So one strategy that my wife and we use is that literally every Monday we go through our IRA stocks and we sell a covered call on every one of them between Monday and Tuesday. Not Monday only. We have to look at how the market is behaving on Monday, how the market is behaving on Tuesday. There's a week where it is so unpredictable, not worth the. So you just sit back and, like Warren Buffett says, just sit and watch a movie rather than worrying about the market. So then, what you feel typically you should have a strategy like that by Monday and Tuesday. Sell the covered call, and especially right now, because market is so volatile, I don't go for 2 weeks out or 3 weeks out because the world is changing on the dime here. So typically, I only sell weekly calls, and a typical week for us for the last few weeks has been where by Monday or Tuesday, every stock in my IRA, I have sold a covered call on that. Now, some of them get called out. Some of them I just pocket the premium. If they get called out, I say, okay, I'll just go buy that stock again when it dips again. And that's how I have kept my strategy, and it's just served well.
No, but in general, right? I think the people say that you look at implied volatility, and when implied volatility is high, you sell options. When implied volatility is less, you buy options. So it's implied volatility is basically a function of how much premium you can get, right? So and the other thing is setting the strike price, finding the optimum strike price where to sell your covered call for. It's a tricky thing. It's a balancing act. The closer you sell it, the higher premium you get it. But I think Thinkorswim has this chart. They call it cone of probability. You can set your probabilities, and you want to see that the stock will fall in that cone. That way, the covered call you sold will go worthless. It's one of many things that people use. It's not the thing, but that's one of many things.
One more thing to add is that if you bought a stock at $40 and you sold the calls for, let's say, $45 for next month, you wanted to be right at, I say, 44.5, because what you can do is then the options you sold will expire worthless, and then for following month you can try to sell another call for $50. So now you are trying to up your upside and also trying to pocket more and more premium on a monthly basis. So you do want the price to go up, but you don't want it to go above your strike price, because you want to cash on the next upside in the following month.
Yeah, a lot of great points, right? Yeah, the tax implication, you talked about implied volatility, some of the technicals, you can look at charts and make determination of that strategy. But to answer I was being, more jestful earlier when, I'm not really that tied emotionally to my stock, but the reason sometimes that wouldn't work out, right? Hey, why not buy 100 shares again, right? And a good example would be, let's pick up Fastly, right? Fastly is a good stock. So I liked Fastly, FSLY, when it was, $30. I liked it. I bought it. I sold some covered calls. And then in the COVID time, it just spiked. It spiked to 110, something like that. So my shares will get called away. Now, I have a choice. Do I want to buy costly 100 shares again at 100, at $100 price? I am not. So I'm not going to buy. So that's why in those situations where I do not want to buy at such a high price because it has appreciated so much, but I still don't want to lose it. So there are some ways to handle that.
So can I?
in that situation, I mean, as you're tracking it, sometimes if you still feel that the stock has more upward momentum, you can close your position. You know, you can pay, you can lose some money on the option, but still keep the stocks, right?
Yeah, absolutely. The good point. Yeah, you can, if you're really emotionally tied to your stock, you know, you can pay whatever price of the stock is, you know, close it out and save your shares if you really want to. Yes, all options are on the table, no pun intended. So let me, you know, when I show some screenshots, you know, you'll get an idea, and I'll get to that too. You know, this is just trying to be verbal on, you know, what are we, how does it look like in actual options, right? So quickly again on the E-Trade, there are many levels I mentioned, right? So level 1 and level 2. Level 1 has the covered calls, level 2 has different strategies, level 3. So when you actually want to get into options, if you have never done this before, when you try to trade options, E-Trade, for example, will tell you, hey, you need to apply for an option upgrade. So you click on that, answer some questions, and then you would be able to trade options. And then if you think that you need to trade, you know, more level 2 ones, then you apply for an options upgrade. Again, click on a screen, accept their, you know, whatever the terms and conditions are. But if you want to go to level 3 and 4, you might, in addition to applying for upgrade, you might have to get a margin account also. So that's how these, so that will be the first step you might have to do when you actually start trading options. Apply for an options permission or activity level, depending on whatever they call it. So how does it look like actually? Once you are, let's say you have the upgrade, now you can trade options. So what happens is when you go to a ticker, let's take an example of Datadog here, DDOG, and then you select, you know, the ticker, the option screen will load. Maybe I click too much. A blank screen will load in. This is an E-Trade example, right? Datadog is at 87.45. This blank screen will load, and then you will have to fill out the fields here. And this is how you would place an option trade. So when you select a strategy and there is a help me choose, again, you click on that and you will get some links on what they are. And when you click on this drop down, it'll show you about 10, 15 different things you can do on this options page. If you select covered call, and this is an example I was referring to, where you don't have 100 shares, but you select covered call, you will get 2 line items here. You will have to buy 100 shares, and then you will have to sell a call. And I really like that because, you know, it's a great example of, you know, I do like Datadog. I want to buy 100 shares, but I don't want to buy at 87. So by selling a covered call, what's happening is the date here is, you know, you get to choose a date. I'm selecting, let's say, July 24th, which is next week. I'm selecting the same price, 87.5. It's a call, right? And the bid spread is, you know, 285 to 340. Monday morning or whenever. You can place the trade anytime you want, but let's say you do it on Monday morning. This is the spread. You can, this will be a net debit, right? So, okay. Yeah, so this will be a net debit because you have to buy 100 shares. You will get some money back by selling the call. So let's take a look at the midpoint here, 84.63. So you're essentially paying 84.63 to buy Datadog, which is at 87.45. So that is the beauty of actually buying a covered call right away. You know, buy 100 shares and sell a call. You're buying at a lower price. And if Datadog appreciates more than 87, you know, you still, you know, made some profit. So that's one strategy. Now, if you already have 100 shares, you don't have to select covered call on the top, right? Did I skip that? You don't have to select. So you can just select, let me see why I had this previous one. Okay. Yeah, maybe this was the one I was trying to show that, you know, you can select different dates and different prices. If you look on the right-hand side, it shows you all the calls on the left-hand side with different strike prices and different bid and ask spreads for July 24th. When you are buying a covered call, or sorry, selling a covered call by buying 100 shares, you can select whatever date you want. The farther you go out, the more premium you will get. So, and your cost will reduce, right? So that's an advantage. If you don't own 100 shares, or if you already own those 100 shares, all you have to do is come to the options page and just say, I want to trade a call and I want to sell to open, right? So that's what it will be called typically. You're selling to open a position, And this was a tough terminology for me to get to initially 5 years ago, but that's, I'm more comfortable now. So yeah, so you will, you have 100 shares and you'll say, okay, I'm going to sell to open a position for a call, selling a call. And I'm selecting August 28th, right? Typically, I would select my strategies, about a month out, a month to 2 months out. That is typical strategy for me to answer from a previous question on, what is your strategy? And I'm happy to collect this $410. 4.410 is the premium times 100, so I will get $450 by selling this covered call for Datadog, which is at 87. And see the price. I've selected the strike price of 100. I'll be happy to sell it at 100. Right? If it reaches 100, I'll be more than happy to sell it at 100 and collect an additional 450 or whatever the price is. So that's the advantage of the covered call.
Hey,
but how do we manage?
Question I have.
On the screen, how does the duration work on this?
The longer the duration, the more, just in layman terms, right? There are technical terms to describe this, like implied volatility, and there are 4 technicals that option traders play with. I don't typically, but there is beta, gamma,
the
theta.
Duration is not. So it is this. When you place this call, it's valid till April 28th. That's what it is. That duration is not.
Yeah, the contract is valid till August. Yeah, contract is until August 28th. I can select September, October, November, December. The further I go out for this strike price, I will get more money. And the reason is the stock has more time to reach 100, right? If I sell a July 22nd call for 100, I won't get much because the chances of it reaching 100 in 1 week is probably less. But the chances of Datadog reaching 100 in, let's say, January of 2021 is pretty high. So you will get more money. So when you're selling a call, and I've done that too. I have some stocks that I collected a huge premium by selling them for January 22 actually, in 1 or 2 cases. And I'm happy to sit on that stock for 2 years, hoping that it'll appreciate.
Right, right.
So I have a question. So you mentioned that you do the calls on a monthly cycle, right? You call it out a month. And so do you go to the monthly cycle? The third week is essentially the monthly one, right? That happens. And then you have the weeklies, right? So when you say that you give a call out on a month, do you target always the month closing week, or it could be from any point in time 1 month?
Yeah, I am very retail, this is a very deep question. I actually don't look at any of that. I, just eyeball and say, what, I'm in July, I'm going to select, August 14th or August 21st. I don't really bother whether it's, third week, first week, second week, whatever date is available in August. I take a look at the price. I select the price. I'll be happy to sell Datadog at 100, and I'm happy to collect less premium for that if that happens, right? So I don't have a technical strategy to select price, and but there are strategies available to, as many of you have mentioned, right? Look at charts, look at different things. I really literally eyeball it. I look at, between this month and next month, can I squeeze $100 out of the stock? That's what I'm looking at.
I think Chakri brings up a very good point. There are numerous strategies, and also the market is changing so rapidly. So different options where to look for. For example, let's say if we see that Apple next week doesn't have much news, it's not going anywhere as such. Apple is at 385 right now. So let's say on Monday you buy Apple at 385 and you sell for that Friday a option for 385 itself. And that is currently going at roughly $7. So guess what? If the stock is not going anywhere and is hanging around 385 and you are getting $7 on that in 1 week, 5 working days, you're getting 1.83% return in 1 week, right? There are these kinds of strategies where we can make decent money and small chunks. And so that's one suggestion of how you can look at stocks that are not too volatile, but you can still go ahead and procure the stocks and sell it near the what's called strike price. Chakri, one thing you may want to also offer them is the out of money and in the money kind of a.
Yeah, I mean, that is, I don't even know. I mean, I know what you're saying, right? That what does in the money mean? What does out of the money mean? But, when I'm trading options, it doesn't really matter to me. That's why I was trying to show the screen saying, this is how I step through an options. I don't really worry about whether it's in the money or out the money, because intrinsically I understand what it means, right? Even though I'm unable to explain what you're referring to, right? In the money is based on is the stock price above the strike price? If it is above the strike price, it's called in the money. If it's below the strike price, it's called out of the money for a call, right? And for the put, it's the otherwise. So terminology is great. I have difficulty trying to understand and explain it. So that's why I stepped away from it, because in order to actually trade, I feel like I don't need that thing. But is there something that is there something that I'm missing on that one that you can elaborate?
Okay, I have a question.
Okay, maybe.
Can you hear me?
Yeah.
So what is the use case? I think I was trying to look for use case. I don't know who else would be. Is you're actually going for a swing trade. Let's use Datadog, right? So buy at 87.45, and I'm looking for a 10% increase, right? So, but I also would do a short sell if for some reason it goes 3% less. Okay, because I was only looking for upside, and if it goes down maybe 3-5%, I want to sell. So for the downside, how do I pair the put for when the price goes down? So instead of doing the short stop, I would use a put, and then what would be the price difference? So like when it goes down 3%, I'll be losing let's say $2 or something, right? But instead, if I buy a put, would it be cheaper? I mean, what is the comparison there?
Okay, put is exactly the opposite of call, right? And I will probably talk about that a little bit. In this context, for example, right? So here I'm selling a call for 87.45. What scenarios would I buy a put? I can, again, it depends on what you want to do. For a put, you can sell a put or you buy a put. When you buy a put, you are basically trying to limit your losses, right? So I can sell this call, but maybe I'm not confident that, I'm not very sure about Datadog, and I want to limit my risk. I don't want to lose all my 8,745. So I can, at the same time, add one more leg in this and say, I want to buy a put for 85, right? So what that means is I will have to give some money to someone to buy that put for 85. And if the stock goes below 85 to 40, I still have the right to sell at 85. So that is a put strategy, which we're not explicitly covering here, but that's how a put would work. I also use put to actually buy stocks where Datadog is at 87.45. And I've started to do that only this year, and I've done this on Datadog actually, where I said, I want to buy Datadog at $80. And I sell it, instead of selling a call, I'm selling a put. I don't have any shares, but I'm selling a put. You can do that when you're selling a put. But you need to have that cash to be able to buy at 85. If Datadog does fall below 85, you will be obligated to still buy it at 85. So do that only again on stocks you're comfortable with. So it depends on, so the put strategy exists. You can either, depending on, what is do you want to buy or do you want to sell shares at a particular put strike price? And that's how you use that instrument. And all the option strategies are a combination of that. So there are option strategies where you sell, at the same time you sell another call, or you can sell a put and sell, it's a very complicated world. So depending on what you want to do. So if your particular situation, you want to, like I said, you want to limit your risk, at the same time, when you're selling a call, you will buy a put. Does that help?
Yeah, I was actually that this helps, but my question is, without trying to make money of a 100 stocks that you have, right? I think that's what you're actually covering. But like say if I'm just trading stocks, okay, so I want to hedge the option strategy for the negative side. Okay, so what is that can be used?
So I think if you do the stop loss, when the stock hits that stop loss limit, the order would be exercised, right? So you're out. Whereas if you buy a put, you have to pay a premium, but that put protects you for the duration of the option. So if you have that put for, let's say, 2 months, then during those 2 months, stock can go below that stock price and come back again, but you always have an option if you want to get out of it at that price. I think that's the advantage, that you have that time to see how the stock moves and if you want to exercise that option during that time period. I don't know if that helps.
Okay.
Yeah, I think there is more to it, that question though. Maybe let's put a pin on that. Let's come back to that, if we have time, or we can cover in future sessions. Like I said, the option strategies, when you look at each option strategy and how it is set up, it'll give you an idea. So this one is, just selling a call and collecting the premium. So,
yeah.
And again, a Datadog example, right? So, I don't know why I had this slide. Okay, yeah. The reason I had this was, again, to answer that question on, you can buy the stock again, right? I don't want to buy Datadog again. I had bought it at 40. I sold a call for 60. It went way beyond that. Then I did something so that I sold a call for 70. How did I do that? And then what is my current strategy, right? If I bought at 40, I sold a call for 70, but that stock is at 87. Should I just sit still till January 15, 21 and do nothing? What would be my scenario? I think that's what the reason for this slide was. So let's take a look at that in this particular scenario, where you bought it at a price, you're happy to sell it at 70, but it has gone way beyond that, and there is still 6 months. What do you do at that time? And this is one of the reasons why I like E-Trade mobile app, where in the app itself, for this particular row, before I get that. So, I was on this slide, right? Sorry, the reason I had the other slide was this. So I was going to show that once you place an option, what happens, right? When you place an order to sell a covered call, it shows up as another line item under the stock that you own as -1. I think that's why I wanted to have this slide also. Once you buy that, this is how it'll look like with, the price that you paid, what is the current price of the option, what is your profit, what is your loss, percentages, and all that stuff. Typical to a stock, same thing, except that instead of 100, you will see -1. Okay, so here is an example of, now Datadog is at 87. I sold the call for 70. What do I do? One option, do nothing, as some of you have said, right? Just wait, let it expire, let it get assigned, and then buy it again if you want to. That's one option. As with options, there are many, many options. So I'm going to show the roll option, where there is a strategy available for me through E-Trade, for example, which is roll, which is essentially what it means is when you select the roll option, E-Trade will load the screen, and basically it's adding 2 legs to this trade. It is automatically placed a line item to close the covered call for January 15, 21 for 70 that I had. And then it adds another line to sell another covered call. So essentially, rolling a covered call means that you're closing your current position by buying that call, and then you're opening another position by selling another covered call at another expiration date and at another strike price, right? If you want. That's what this screen does that. And I do this a lot, actually, especially in this COVID time where everything has appreciated beyond my screen, beyond the price. I'm like, okay, you know what? I will, I set up a, especially for Datadog, I had a call for 60. It went way too much up. So I rolled it over to a call for 70 for January 15th. Right? I will roll it again. And there's certain options you can have when you're rolling an option, right? You can select a different expiration date. So instead of January 15th, I'll say I'll go to March 19th, keep the same strike price, and collect some additional money. So you're losing on all the upside, but just by rolling over by a couple of months, you still get another $200 that you can squeeze out of this stock. If you're willing to do that, that is one option. The other option is...
Don't you lose money?
Yeah.
Because you are closing the position?
Yeah, you are losing. So this is what it looks like. So buying, you're losing money in the 2370 or 2630, something between that. But by selling, you're making another set of money, right? So the net credit is you can get up to 235 by choosing a different expiration but the same strike price. Just willing to hold the stock a little bit longer can get you a little bit more money, and you can you can do this forever, if you want to. That's
So
one option. Yeah.
check
And
just one.
is this, sorry, go ahead.
No, I'll just so one thing to remember is there is a wash sale implication, right? Because you're taking a loss and then you're buying something right away. So depending on which accounts and whatever, you could have wash sale implications. Just something to remember.
So that's a tax implication.
Yeah, tax, whether you can take the loss or not.
Actually, for options that doesn't apply because you are buying it. So every option is a separate security. So you are selling one security and buying another different security.
You mean different expiration?
Yeah, so wash sale doesn't apply in this case.
I was just looking it up a little while because I never had to deal with that, but it is questionable. So there's different opinion
Like
on
if
that.
you are buying the same option, then it applies. But every option, every strike has a different symbol, basically.
Yeah.
Right.
Same strike price and same expiration date.
Yeah,
Makes sense.
Yeah. So the point here is, again, as Suman had mentioned, right? I mean, most of us, use like an IRA account where, or I think Raj, you were saying it too, we use an IRA account where I don't have to worry about these things, right? But if you are,
you still have to worry about wash sales between IRA and non-IRA account. Those
really?
trades,
Okay.
yeah. So if you only trade in IRA and you never touch anything else, you're fine. You don't have to do anything. But if you take a loss in regular account and then you immediately buy it in IRA account, even if you buy it in your spouse's account, you're still accountable for that wash sale. I know.
Okay.
They try and get you.
Yeah, so I'm only using most of the time IRA account, or I don't mix and match the shares I'm using in different accounts. But can you explain a little bit on how does that wash one impact me, like at the time of tax filing? What do I have to do?
So for the option, like somebody clarified that if it is a different expression, it doesn't matter. So
but
if
even
there
for
is
regular stocks,
yeah, for regular
just
stock,
quick.
Yeah, so for regular stock, if you sell and then you immediately buy within 31 days, the same security, that's what IRS calls it, similar security. So if you sell SPY at a loss and then you immediately buy another mutual fund or something else that basically tracks S&P 500, it's considered similar security. So then what the IRS is saying is you cannot take the loss of your original sale.
Yeah.
You can take it. Eventually, you'll take it, but you cannot take it right away. It becomes a deferred loss. And so again, this is important because if you have multiple accounts, so let's say you have Fidelity and then Ameritrade, between Ameritrade and Fidelity, they're not obviously talking to each other, right? So they're not doing this for you. Like they're not keeping track of. You have to keep track of it separately, and it gets a little more complicated too because the IRS knows that you might buy it in your wife's account too because it's all a joint, within the family. Even if you buy in your spouse's account, as long as you're filing joint, you're still have to do a wash sale. You have to report it and do it that way. I'm just pointing out this because at a certain point, these things can really come and bite you, right? In terms of you not reporting something that you thought you're good, and then somebody comes in.
Yeah, you don't want to be in trouble, right? So I still, on paper I understand, but I don't know exactly how it will play out when you actually are in that situation. But thanks for that. So it's something to watch out for. So thanks for that, nice little digression, moving away from the intent. But I needed that clarification. So thanks for that. So,
I had a quick question for Raj. Raj, is this what you do? You said like every Monday or Tuesday, you guys do sell covered calls. Do you basically do the rollover?
No. I just simply go to the equity positions that we currently have
Uh-huh.
And we look at it and, basically, again, keeping in mind, events around those equities, from news events to dividend coming out to any kind of, earnings numbers, also any
Okay.
competitors of that company. So we just do a basically high level checkpoint to see in our scan, is there anything there that's happening that will
Okay.
the stock to fluctuate one way or the other. And then once we are comfortable, as Chak mentioned, we look at the entire option table. And since I have a very clear mindset that I'm only selling weekly calls, so that makes my life a little easier. I'm looking at, a month down, 2 months down, because then the combination and variation becomes quite a bit. I just only look at what's expiring this Friday for that given equity. And then based on the news items that I have studied, and I see my judgment of how much upside, downside it is going to be. And then based on that, we sell, we pick the price and the strike price and then sell it, and then just twiddle our thumbs watching it fluctuate.
Okay,
Yeah.
got it. So you don't necessarily sell weekly, like next week's option. It could be any weekly option in the future.
No, I only sell it for that Friday. By Friday, I want to be able to sleep. I mean, by Friday, I'm all the options. I don't want to worry about it. There are times where, I missed out on a opportunity here and there, but then, you just look at that by Friday, I want to be, especially in today's market, when it used to be monthly, then you ride the whole monthly wave. But right now it's purely weekly calls we do. And very rare I do 2 weeks out. Sometimes I will do 2 weeks out for a dud kind of stock that doesn't do a whole heck of a lot. And I get a better premium by giving the time benefit to the buyer. So I will do a 2 week out, but stay tied to the date.
Okay, got it. So you're basically collecting weekly rent.
Yeah, collecting weekly rent, exactly.
Nice.
So I have a question. So your strategy is weekly, whereas Chakri was saying his strategy is far out, right? He does month or couple of months or even 6 months he has done. So these weekly premiums, if you keep adding, does it add up to the 6 months one, or is there a differential on that? Because the time is a major component in options, right?
The time is, and also volatility. For example, we made ton of money on Netflix. Netflix, interestingly enough, because the earnings were coming out last week, we sold some puts on that, basically, selling insurance, as Suman mentioned. And basically we said for 575, when the stock was at 530 or something like that, and it gave us $10 for that. That means the stock had to, it already had gone up so much. Then it, after earnings, it had to go up again, up from 530 something to 575. And since we collected $10 premium, I was willing to buy the stock even up to 585 before I started incurring losses on that transaction. So,
okay. So you played a put sell option when the stock price was at 530 for a strike price of 575, and it doesn't get assigned to you then?
Yeah. So I had to be ready in case if the stock went above 575, I had to be ready to dish out that much money.
Oh, okay. But you played a put, you're saying, right?
Yeah, that one I played a put. Yeah, exactly.
But if you play a put, that means anything lower than the strike price, it gets assigned, right? So maybe I'm missing something here.
No. A put is basically I am selling an insurance where I am committing to buying the shares at 575.
Got it. Okay.
That's what I'm committing to. And somebody who's saying that, okay, hey, I just want to make sure that I'm in a position to dump it at 575. Does that make sense?
Okay.
And what was the price when you bought the put for 575?
You'll be surprised. Suman, you'll be surprised. I mean, because Netflix was so volatile that it was around 530 or something like that last week.
Yeah.
And, because these stocks were swinging $100 one way or the other, right?
Yeah.
And for that reason, and also they had a very major event coming up, which was the earnings.
Yes.
So for that reason, there were two sides of camp on Netflix we saw. There were those who were very bullish, and those guys were willing to buy the stock at 575, and there were those who were on the short side, and they said, hey, this is going to tank because it's already had a nice run up.
Yeah.
You know, so the premiums on Netflix were very, very good last week.
So
yeah, I think, yeah, sorry, go ahead.
So you already own like 100 shares of Netflix?
No, did not have any. On that one, I did not have any. I just had enough cash in the IRA that should I end up buying at 575, I had enough cash to buy that.
Oh, okay, got it.
Yeah, so that's called a cash secure put, right?
Enough,
so
margin to cover it. Okay.
Correct.
Yeah.
Okay, this is a very okay.
Yeah, so that's a good way of buying shares. Like I said, I'm starting to do that where, I am selling puts so that if stock falls, I'm happy to buy at lower prices, right?
Yeah, but maybe what about understanding that that's a strategy that's right. If say, for example, like it happened to me when Beyond Meat BYND was hovering around 150, I put a put sell option for I think it was 235 or 250 premium for 140 a couple of weeks back. Now it went down to 130 or 135 got assigned to me. But do you put also on a higher strike price? Because this strategy was very. So what is the loss in this? If you're expecting that something is going to fall, then everyone can put the put option with a sell right at a higher strike price. What's the downside to it?
Chakri, when are you going to go over the puts? Because I think first we may walk through the puts before.
I think there are more experienced people on puts. So let's do this, right? Let me cover these additional slides on covered call, and then, I do need to step out in about 20 minutes at 5 for my kids' baseball practice. So what I'll do is, let me cover these slides, and then maybe we need a separate session on puts on, how we can use puts as an effective strategy. And then, of course, many more sessions will be needed on iron condors and butterflies and straddles and triangles. Each one of them would take, one session. Now that we have covered introduction,
let us just focus on covered calls.
Yeah, that's fine.
Yeah. So let's get to the covered calls and then see, how maybe we do the puts, cash secured puts next time if anyone wants to cover. I can share, what I know, but let's see. Let's go through this first. So as I was mentioning in the previous screen, right? So what do you do in a situation where the strike price of the stock has gone way beyond what, the price of the stock had gone way beyond what your, strike price was. So here is a rolling option. Automatically, you will get two lines, one to buy, one to sell. And then you have other options too, where by choosing a selection of expiration date and a strike price. So let's take a look at just two examples, right? So you can go to a higher strike price, right? So you initially sold a call for 70. So the first row here is, you're buying to close that line out, and then you sell another call. You can choose to sell another call above the current price, right? It's Datadog is at 87.45. You can choose to sell a call for another date for 90, for example, strike price of 90, so that if it does reach 90, you make more profit. However, because it is at a higher strike price, the premium that you receive will not match what you will have to pay to buy a previous position out. So you might have to pay, for example, 26.30 to buy the previous position to close it out, and you will make only 16.60 when you sell a new covered call. So with that, in this particular one, your net debit would be 9.70, right? If you're lucky, you have to pay only 23.70 to close the position out, and you might get 18.10. So automatically, these are the limits, right? You might have to pay 560, or you might have to pay 970. Between that range, let's say midpoint is 765. You can pay that extra money, 765, to move your strike price from 70 to 90. If you don't want to, which most of the cases I don't want to, I am happy to roll it over to September of 21. Wow, more than a year out, right? But if I do that, right? What do I get? I actually get a credit. So not only I have moved my strike price from 70 to 80, I'm getting some additional credit, right? 180. So there are, the point of this is there are many things that you can do. You can do nothing, or you can roll over at the same strike price, be willing to hold it a little bit longer to collect more money, or even actually pay a little bit premium to increase your strike price. So there are many options available for you if the direction of the stock is, uh, way high. The direction it moved is, way beyond your strike price. So I tried to put together a tip slide. I really don't have many tips, except that, stay away from volatility, right? And when you're selling an option, maybe it is a good idea to see if there is an earnings date around that date, right? So if you're selling a Apple August 14th call, just see if there is I think like others were mentioning, right? Is there earnings happening at that time? Their stocks tend to be volatile around that time. If you're selling a covered call, maybe you want to stay away from it. Or maybe you want to step into it. It's up to you, depending on your price point and strike. Now, I typically stay away, try to not select those dates. But really, I don't really have a strategy on that particular one. I'm just happy to select a good price, right? And as I said, if the stock does move beyond what you had intended, you have different options to roll over or do nothing and just buy another leg. So for some stocks, I have done that, like bought multiple legs. Additional info, I do not know of any good websites for options. If someone knows, send it over. I know that Investopedia has an options trading guide. At one point, I tried to go over that, and it gets very technical. And many of these options books, for example, I've read an options book some time ago. I don't really have a book to recommend. I would guess they're all the same. Depending on what you want to do, you might want to pick up a basic book on how to get started on options, for example. That should do the job. But the best thing I've seen is the brokerage accounts. So TDA and E-Trade, both of them have like videos on that. They have almost like classes that you can take and step through the classes, and they get very technical. That's where you will get to see all the option technicals, the beta, gamma, theta, volatility, intrinsic value, out of the money, in the money, very detailed explanations on that. I've taken some of those, and that probably is my best resource. I don't try to go to any particular website and get additional information. I added some links here, but if someone knows a very cool link that is very useful, definitely, please post and we can add it here. But I found that, the brokerages that we have accounts, they have pretty good coverage of what you want to do in most cases. I think that's it. Okay, I've successfully went through all my slides, so I'm good. Let's open it up for discussion now. I think one thing I didn't cover was the cash secured puts, right? It was on my agenda, but I really didn't get a chance to put any information together on that.
Yeah, we will do a separate session for puts like we mentioned, so that should be good.
Yeah. I have a question here. Say if you are, the way that I'm envisioning, say if you are kind of sitting on unlimited cash, so for the next 5-10 years, that you can actually pump in any amounts of money irrespective of where you are. Where you are in terms of the position of your investments. With this strategy, you keep buying your 100 stock, the covered call. If it have an option, to cover it through puts or through buying back. If it goes up, also you have to buy back at the same price. The moment it's kind of getting close to your call price at that. So keep executing that. With the unlimited cash you have. I don't see. At least I'm not able to envision a situation where I can make a loss here. As long as there is enough cash with you.
Oh,
at some point you can
there
make
is always. Sorry to interrupt, but there is always a loss, right? Just think, right? Stock market is like not a zero-sum game, right? If you're making money, someone is losing money. And there is a good chance that as retail investors, we are not, I'm not that experienced. And I do end up on the losing side. Let me give you a good example.
Yeah, we're talking about market leaders. We're doing this against market leaders.
Yeah.
and you know we know to some extent, unless the companies go bankrupt.
Yes,
Typically
that
you're
is the
doing it
risk.
with market leaders and say like an Apple or Amazon, and wherein you see at least for the next 3 years, 4 years, you bet on that risk. Except for that, betting on that risk, um,
So,
except for,
I mean, that's why, you're right? The bad example I was gonna give was Luckin Coffee, right? I bought Luckin Coffee and it was like $40 a share, like, oh, cool. And then I'm
that
trying
is
to sell
getting
covered calls.
no, that is getting
After,
greedy, isn't it? That's not a
yeah,
market
that
leader,
was,
in my opinion.
I know. So you're
Yeah,
right. So if you select good companies, you can do
yeah,
this forever, right?
yeah. You can do
But
this
that
forever.
risk
In
is
fact, you're
always
happy
there.
if the stock falls down. You're happy if it goes up. Only if you have unlimited cash.
so
Okay,
can I?
someone needs to go on mute. I think there is a lot of background noise.
Then you can mute everybody, right? Yeah, there you go.
Okay. Yeah,
Yeah.
I like that point. Yeah, if you are careful, if you have that experience to select good stocks, I haven't been unlucky. Maybe I should select market leaders, but they're so pricey for me. So, but yeah, if you have, uh, if you can
Yeah.
do that, absolutely recommend this strategy. I like it a lot.
So
Yeah,
one.
Chakri, to your point though, market leader, when you select them, then there is not too much premium in there either.
Exactly. The ROI won't be the same.
Yeah, it's not that easy. And in regards to risk, yes, options are misunderstood because somehow, I don't know why, but people have thought, oh my gosh, option means I am going to lose my shirt. Well, yes, you will lose your shirt if you are selling those naked calls and naked puts. But if you are doing covered calls, basically you have the underlying stock, you are only limiting your upside gain in a covered call, right? And if you really believe this stock is going to take off, then by no means you should be selling covered calls.
Why? Even if it's going to take off, you can buy another set of 100 stocks at, say you're buying it at 350, and then you have a covered call for 400. And when you see the price, like the stock price at 398, and you think that it's going to kind of hit your 400 and go up, you buy it, you execute another call for, or not another call, you buy a stock for another 100, you buy another 100 stocks at 398. And basically either end up losing the first. Basically you have taken the upside from your initial investment of 100. It's almost like a DCA that you are doing in a different way.
Right, but I think it's right now, as Chakri mentioned, in this short call is hard to explain, but the premium fluctuates dramatically. So if when you sold the covered call at 350 for 400, and if the stock, again, that you're talking about time frame also, correct? If is it for this week or is it for next week, correct? If you are lucky and if it's around 398 and you got a $50, strike price margin out of that thing, that's very unusual, but that would be over a longer period option, not for a short-term option. So I think in those cases, you're right. We can just go ahead and go to the open market and time it and procure it. But I use Beyond as an example also. Beyond has gone up and down. So, by the time when it was taking off, right, my option got called and I wanted to buy it again and it was already up in my uncomfortable.
Right.
Yeah. Right, that's a risk. So again, as I mentioned in the beginning, the reason I entered covered call is not the greatest strategy. Just because I like it doesn't mean it is the best, right? I would actually argue that, as I read more about options, I feel that it is not the best strategy. But if I have more confidence in the butterflies and the iron condors and straggles and strangles, I would definitely play that. I just don't have that experience and the knowledge and the time to do research and get into that. What I was able to get into, the easiest way I could understand was these covered calls, and that's what I tried to share. So the reason I got into it again was I was already sitting on these shares, and I thought maybe I can squeeze some extra money out of them, and it worked very well for 2 years till COVID hit. So it's been crazy since then. So that's my story on covered calls.
No, Chakri, yeah, this was really a good call. because a lot of us have, definitely I, have never dealt in the options, right? So this gives at least an option, even if it's a simple covered call option. I've held securities for years and just kind of they're just stayed in there and haven't done anything with them, right?
Right.
And
Yeah.
so at least this gives an option. So definitely thank you for sharing.
So there's one thing that wasn't covered about covered calls. The risk is there is no downside protection, right? With the covered call, you could sell, and then if it goes down, you are locked until you buy back your option, and then you can sell. What happens is normally this is fine on something like Apple or Microsoft during market hours, but if you want to sell after hours, your option, you cannot buy it back. So you will be locked until the next morning, the next trading day.
Yeah, that's true. And you're right. Covered call is nothing but just an additional income generation on top of a stock. So if you're a buy and hold, you already have that risk of what happens if a company goes bankrupt, right? So that risk is not mitigated by covered call at all. So that risk is always open if you're having 100 shares of anything. Yeah.
But then if you're having those, if you're owning those 100 positions of stocks, you're anyway, you're anyway stuck, I feel, right?
Yeah, exactly. That's what I was trying to say. Yeah. I mean, the risk is there. Yeah.
I mean, you're capping your upside, right? So for the premium, you're capping your upside and you don't have any downside protection. So it's not like free money, like somebody was saying. You have that risk. And you know, some strategies, they work very well during some market conditions. And, you know, sometimes these things, they work very well until they stop working.
Yeah, absolutely. That's been my experience, right? I've had very good success with many covered calls over many years. And then in this very volatile time, pretty much more than half of my positions have gone beyond the strike prices, right? So yeah, I mean, that's the thing with options. Different strategies for different markets, for different philosophy that you have. Covered call is not, again, not the best strategy as you're mentioning. It's the same risk as owning a stock, and you're limiting your upside, right? And that's what I was trying to show by, how do you use roles to try to, continue to participate in the upside swing. So, but yeah, and if someone is using other option strategies, it'll be good to share in this session so that we can benefit. I do feel it's very powerful. Options are very powerful. So you just need to know which ones to play and how to play.
It was a great session. Thank you.
Thank you.
Thank you, Chakri. That was a good introduction to us.
Thank you.
Hey, just one more thing as a strategy. So generally more options expire worthless than not. So as a general strategy over the long term, being a seller of an option is more profitable than being a buyer of options.
I mean, to be honest, that's my experience too. But I would let more experienced people about that. But when I first got into options, I was not doing covered calls, and I was actually just buying calls. I was giving premium, and never, I profited from that. So I was like, why I'm giving this money to someone? Maybe I should collect it. That was one of the thoughts of me getting into this. So, good point.
Well, the other way to look at it is, I do options sometimes, especially when I have to make some money with the stocks I can't sell because it's lower than the price that I bought it. Is that like beyond, if you see Govinda and Suman and all these guys keep posting that in a couple of months' time, they're hoping with the way the company is, it will go to 160s and all back. But till that point in time, I'm a little way below the price I bought it. It's a good way to keep milking some money out of it. That's the way at least I look at it sometimes.
Yeah. And maybe in the next session, I can cover the cash secured puts, right? Some of you mentioned, what if I have a lot of money, but I'm hesitant to get into the market, right? You can just buy puts, sell puts where, you can generate some income by selling puts if you're willing to buy the share at that price, right? So obviously, again, you do this only with stocks you're confident with and stocks that you don't mind buying if they dip. So maybe something that's we can cover in the next session, in a future session.
Hey, great, folks. Thanks. Yeah.
Thank you, Chakri. Cool. Thank you, guys. Have a great weekend.
Thank you, Chakri.
Yeah.
Thanks,
Chakri.
Thanks, Suman,
Thanks, Raj and Krishna, for chiming in.
setting this up. Yeah.
Great.
All right.
Bye.
All right.
I'll
Thanks,
share the
everyone.
recording
Bye.
later this evening.
Hey, Suman, can you also forward the presentation?
Sure. Is that okay, Chak?
Yeah, absolutely.
Okay.
As long as I get some premium.
What is your expiration date for the stocks?
I deal in 6-pack, so yeah.
Okay. That sounds good.
All right.
All right.
Cool. All right, guys. Take care. Bye.